Welcome back to Mortgage Markets and More. I'm your host, Peter D'Angelo from Rate. I hope you're doing well. Today, we're going to be taking a look at these mortgage rates and what's going on in the market. We're going to review what the Fed had to say this week, and then we're going to take a look at what's going on with New Jersey in particular and some housing statistics there. Maybe a little bit of commentary about what things are going to look like over the next couple weeks if you're out there shopping. So without further ado, let's get into it. Let's talk about where mortgage rates are as of the recording of this podcast episode, the Thursday morning before its release. According to Mortgage News Daily, 30-year fixed-rate mortgage is averaging 6.86%. The 15-year is averaging 6.19%. The 30-year jumbo is averaging 7%. The 30-year FHA is averaging 6.25%. The 7/6 SOFR adjustable rate mortgage, that's averaging 6.45%. And the 5/1 SOFR ARM is averaging 6.28%. And that one is according to bankrate.com. Overall, mortgage rates have elevated a bit compared to where we were last week. I was a little bit more optimistic, and then the market did what it did, and here we are. Let's take a look at the bond market because that's showing us what we could be expecting here in the near term. 10-year Treasury yield is at 4.318% this morning. The 5-year is 3.918, and the 2-year is 3.83%. So these yields have all risen proportionally, but still that 10-year bond jumped up quite a bit. We were at 4.14% last week with our update, and as we can see, 30-year fixed rate mortgage is up from the 6.79 thereabouts it was averaging last week, and it elevated up a bit. Why did this happen this week? Well, in the very immediate past, we had the Fed with their meeting and their policy announcement that was completed on Wednesday this week. And essentially, they held their benchmark interest rate, the Fed funds rate, at 4.25 to 4.5%. The commentary is the important part right now. We've talked before. There wasn't an expectation that the Fed was going to cut their interest rates. Just doesn't make sense right now because of all the volatility that's occurring. And it's tough to say if there's economic instability because of how the economy's going or if it's driven by the news, the headlines, and the speculation that continues to change the narratives back and forth. The new risk that was identified that Fed Chair Jerome Powell mentioned was that the tariffs could stimulate a situation which is a little bit of a nightmare where we have slowing growth in the economy. That's not good. And inflation goes up. So that means like people aren't spending money, but the cost of everything goes up. And in that scenario, which would be stoked by tariffs if they're not managed properly, could be something that the Fed has to be prepared to manage. Number one, they are not going to preemptively cut rates. So what that means for us is we need to see inflation moving downward and we need to see stability in the job market. Then we'll see the Fed cut rates, or if there's some sort of severe negative impact to the economy and the Fed needs to step in to help to stabilize. Those are the only scenarios right now. So that means they're not going to be preemptive. Secondly, they reinforce the same thing we continue to hear. They're staying data dependent. That reinforces the first point. They're going to continue looking at those things, inflation and the job market. Lastly, he did say, and this is the quote, they're doing a patience play. So they're going to patiently wait and see how things develop, which means for us, we can expect this elevated interest rate environment for the foreseeable future. The market sentiment before the Fed meeting was very volatile. That's why we also saw the interest rates increase. The interest rate increase that we saw week over week was not necessarily a fundamental of the Fed meeting, but more so of how the market was trading and what was going on in the markets over the course of the week between the last episode that we aired and this week. The post-Fed meeting, which is very immediate, just that afternoon, there's only a couple hours of trading after Fed Chair Jerome Powell makes his commentary, and it helped move interest rates a little bit lower. So our rates today would have been a little bit higher. So there was a little bit of relief actually from the Fed meeting. The forecast here is that most analysts right now, and I think I'm in this boat. Most analysts see 6.5% to 7% as our range bound for a 30-year fixed rate mortgage. That's what we've been seeing more consistently now. It's still volatile because we've seen big swings quickly, but we have been staying within that range with just a couple times there where we popped up above 7%. So I think that that's where we're going to be. Everything's going to be very dependent on all of the economic data. So it does not take for the Fed to say anything or do anything for the interest rates to change. And because we know that the Fed is data dependent, if there's a good inflation report, people will get very optimistic. We could see lower interest rates. If there's a negative employment report, then we could see better interest rates without the Fed saying or doing anything, because we know from the Fed that those are the important things that they see as priorities for themselves. So the market's going to speculate accordingly based on those things. Now I want to move along, talk about New Jersey and what's been going on here, because there was a bit of an inventory surge. So statewide, the active listings are up quite a bit. We're talking about a factor of 15 to 18% year over year when we're comparing this time to last year. That totals over 9,000 new listings. The hot markets I wanted to highlight today: number one standout, and this information is actually according to the data that we have from March. We're still waiting on April data. Hudson County, listings up 39.36% year over year. And this is as of March 2025. Essex County, listings are up almost 22% year over year. Quite a bump in inventory. The year over year, I always like to highlight, devil's in the details. If it was a rough spring last year, which it was, by the way, if we recall, interest rates went up after January and February. That's when we started to see the hot inflation. Interest rates went up, so the buyer shopping in that market had to contend with higher interest rates at that time. So listings were down quite a bit last year. But still, this is a good sign. That means that this spring market has already got a bit of a boost compared to what it was looking like last year. Now for the price trends in the state, median list price rose up modestly, 0.93% month over month in March, to reach around $550,000 statewide. The luxury market, though, did see a slowdown. So I'm talking about Alpine, Short Hills, markets like that did see a little bit of a suppression of activity. The buyers out there right now, though, are really focusing on the commuter towns. Those are the most competitive markets. So we're talking about Hoboken, Montclair, even places like Bloomfield, Glen Ridge. Pretty much take your pick. If there's a accessible and easy NJ Transit available, that's a go-to. So those markets are remaining very competitive. No matter what happens with the inventory, they stay competitive in those markets. The coastal spots in the state, like down in Asbury Park, Long Branch, all of that, they still remain competitive, but the buyer pool there, that's more of it being a luxury choice and purchasing for those purposes. Other than that, I just wanted to highlight a couple other key statistics for you. Number one, homes sold 25% faster in March of 2025, and that's compared to February, and that indicated an average days on market. So a home was listed and then closed and sold in about 33 days. So the competitive nature is still there, but we're seeing at least one part of the equation is improving. So we're looking good there. Now, just a quick summary for you of everything that we have from this update today. First and foremost, the Fed, because it's recent, they're walking a tightrope. They're doing the best that they can with the data at hand. We've highlighted the issues with the data, though. It lags. It's not 100% up to date all of the time. There are revisions. When the revisions happen, that changes people's impressions. But it's always when the data gets first released that has the biggest impact, unless there's something else that occurs. So this is what the Fed has to manage right now. And that's even putting aside the optics that the Fed has had to contend with as of late. President Trump making comments and kind of throwing shade at Fed Chair Jerome Powell and then walking it back. That's a bad look for the U.S., and that's also a terrible look for investors who are trying to calculate and figure out and forecast where things are going to go in the next few months. Secondly, the mortgage volatility. We are going to stay highly dependent on what these data reports are. So if you are a real estate professional, or if you're a prospective home buyer or a prospective seller trying to time it right and find where that budget is, think of it this way. Anytime you're going to be watching the news, reading the news, and you hear or see any headline about tariffs, about inflation, about the job market, understand that there's going to be an impact to mortgage rates and lending, always. At this point, and it could be good, could be bad, but just keep that in the back of your mind. That's just a little trick, a little tip for you right now. So how does the rubber meet road for that for you if you are a prospective buyer or seller? That means just keeping the communication at a high level with your mortgage advisor, or reach out to me. We could stay in touch so that we could stay in the loop on what's going on. Also, these episodes are helpful because we keep our eye on the ball here. Secondly, rubber meets the road because that can indicate to you maybe you can have better confidence moving forward when you see certain things because you're getting the context now of what the Fed looks at, how the markets are operating. This could be beneficial for you. Knowledge is power. As far as the New Jersey buyers, well, inventory growth is happening not at the level that we need, but the level that we need is incredible. So any progress whatsoever should be celebrated, maybe because there's actual more opportunity now in the marketplace. Now may be a good time. So again, I'm still staying in this perspective. I've been saying it for a few weeks. I said last week, chaotic times create opportunity. This is chaotic right now, but there's opportunity. So as long as you're feeling comfortable and confident, your personal financial situation should be the number one deciding factor. Market speculation is market speculation. Luxury resilience. I want to talk about that space, even though I mentioned that there's been a little bit of a suppression. The luxury market in general has proven to be resilient over time. So when we look back historically, I wouldn't blow anything out of proportion if we've seen a little bit of a suppression in the luxury real estate market. And then looking forward, again, inflation, labor market, all of these things are going to be the most important elements to us as we're trying to manage ourselves and our budgets moving forward and understanding what it will take to purchase in this market, what it will take to identify the right opportunity and timing for you and your family, or if you're a real estate professional, helping to guide your clients through this time, which I wanted to offer this closing thought to this segment. When you're purchasing a home and you're going to live there, it's your primary residence. If you're going to live in a property as your primary residence, you're not a real estate investor. You are investing in real estate, though. And I want to just make a clear distinction on that. Because when you're speculating about where are home prices going to go, what if home prices go down? The only time the value of a home matters to you are in really two main circumstances. One, when you're selling the home. Two, if you need to leverage that asset for financing. Those are the only two times that home value is going to mean anything. And in the first scenario, when you sell the home, you have to think about your time horizon. Think about, if you're buying a home as your primary residence, think about how long you think you're going to be in that property. Let that start to inform your decision making. If you're concerned about volatility with home prices, or if you think that homes are overvalued right now and that the home values are going to come down, every time that's happened in the past, there's been a rebound and things have come back, or there's been at least some sort of growth that's occurred. How long has that rebound taken? We don't know right now. But my point remains this. Use your time horizon to guide your decision making, because it's your primary residence. You are making a decision when you buy a primary residence as your home. You're making a decision to put your money towards something that will build equity as opposed to paying just a home expense, i.e. renting. In the second scenario, if you need to leverage your property for financing, that's when home value will be important to you. You will be able to manage with whatever value is there if you do need to leverage that, if you need to leverage your home for that. So in both of those scenarios, I want to make that distinction. Real estate investors are purchasing real estate for the sole purpose of income. Think about it this way. Anything that you invest in, you're going to get return on, whether it's realized return immediately or future gain return. That's investing. If you're living in that property, your return is there. There's a component of that, but there's no regular return. You're investing in a property and you're building equity in something. So that is part of the calculus. But I wanted to make a distinction just because I think that'll be helpful. A lot of times I've just noticed over the past couple of months, trying to manage and speculate on real estate prices is near impossible in this climate right now for the professionals that do it for a living. So with that in mind, I have found that it's been super helpful to focus attention on just your personal finances and what homeownership means to you. And if you focus on that and you make your decisions based on your personal finances, what you are comfortable with, taking into account the risks and everything, that is going to be your highest likelihood of success and your path of least resistance internally, in my opinion, because you can keep it very clear for yourself. So I hope you found that useful. I'm off the soapbox now, so I hope you found that helpful and useful, as well as all of the updates here. Excited to get you your next update next week. If you have any questions, please feel free to reach out to me. You can find me on socials at peter.d'angelo.rate on Instagram, or you can email me at peter.d'angelo@rate.com. All of my socials are linked below. I will have some more Did You Know updates for you coming up next week and the week following. And we're going to be adjusting our cadence a little bit. I'm definitely going to keep giving the Did You Know for Mortgage Mondays, but those update episodes midweek, I want to be providing you with valuable information. So when I have material to share with you there, I will be putting that out on Wednesdays. But for now, you can definitely expect your market update on Fridays and that Mortgage Monday. In the meantime, have an awesome weekend and take good care.